Hey everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining us today is Mike Shell, who's the Chief Investment Officer and Portfolio Manager over at Shell Capital Management. Mike, thank you so much for joining me here today, and welcome.
Yeah, thanks for having me.
Yeah, perfect. Really looking forward to it. And we've got a lot to cover today, going deep into money management, position sizing, as well as testing different strategies. But before we get into that, I do want to kind of ask you about your overall background, how you first got interested in the markets, and kind of your career up to this point.
Okay, I'll share my screen with you so we can go over that. Mike Shell. I'm the founder of Shell Capital Management, and I've got another slide here that'll get into all the details. But I manage the Asymmetry Managed Portfolio Program, which we custody at Goldman Sachs, and so my professional background, I'll start from here and go back as opposed to the opposite. So I started Shell Capital Management in 2004. The intent was to manage the Asymmetry investment program, which we'll get into. I'm the president, chief investment officer, and portfolio manager, and have been for the last 18 years since I started the firm. In 2012, I also started a separate entity, Asymmetry Fund Management, which was the general partner of the Asymmetry Global Tactical Fund LP. It's a hedge fund, and it actually applies my strategy using derivatives, options, hedging, volatility trading, and just a more advanced version of my strategy. Prior to Shell Capital, I was a registered principal of Raymond James and registered options principal. So I traded stocks and options there, and then so really I started as a stockbroker, as many of us did in the late 90s. So I was a stock and options broker, and then I transitioned into money management later on. And during that time, I learned firsthand a lot of behavioral flaws, biases, and mistakes of my own as well as clients. And so that was a pretty important part of my history. Prior to getting into the investment industry, I was U.S. Marine, got injured, traumatic injury, relatively early in that short career, and then became a sheriff's officer afterwards, and actually worked my way through college as a sheriff's officer. Before that, this is kind of more, I guess, a little more personal background of before I became a professional. My first investment training was I have a BS degree in advanced accounting. It included personal finance and a lot of accounting. So this was an advanced program because I had to have all these advanced accounting classes in order to sit for the CPA exam. It required 150 hours, which is basically a master's degree. And so what I really learned doing accounting, I was going to be a CPA. I was going to focus on tax. And what I learned there, as far as the market goes, is that none of that has anything to do with the market. So fundamental analysis I learned it through advanced accounting education. I learned that fundamental analysis does not apply to an auction market. And so that kind of led me to be more interested in trends. And the reason I say, by the way, it doesn't apply to an auction market is because, in corporate finance degrees, accounting degrees, accounting is actually creating the statements and as well as reading them and interpreting them. But all of that is really more for lending money to companies and being their investment banker. So it's kind of like the CFA. All of that fundamental information is more geared toward investment banks who want to lend companies money or maybe help them go public down the road. But when you deal with an auction market, you're dealing with buying and selling, and supply and demand, and it's purely an auction is more than it is fundamental. Mm-hmm. So business school basically piqued my interest in becoming more active and more focused on managing the risk reward, because back then I would trade stocks a little bit, invest in stocks initially, And I learned the hard way that it doesn't matter how much analysis you put into a stock. You probably only fall in love with it when you really should only date your stocks. And the more analysis that you put into your stock research, then, the more that it probably will end up leading you astray, because if you're wrong, it's hard to, you get into what I call a loss trap. So all of that, though, really, so in the late 90s, got me into, or in the mid to late 90s, got me into more interested in being more active. And I discovered how to make money in stocks, which was one of the first editions, if not the first. It was actually, I think it actually had a shortened name, but Investors Business Daily. Became a subscriber. And so since around the mid 90s, the how to make money in stocks CANSLIM strategy was really what really got me going. And of course, the timing of that was really good, because we had a major bull market. So we had, 5 years of nothing but momentum. So it was the right strategy at the right time. Luckily, though, I was also still concerned about risk, even though, it was a very euphoric time. So but as most of your viewers probably know, the CANSLIM strategy was started by William O'Neill.
Yep.
And it was based off of his studies he did starting, in the late 50s as a stockbroker. So I started as a stockbroker in the 90s. He started in the 50s. So kind of see the thing there. CANSLIM became my primary strategy. As I traded my version of it, we all have a different version. So I never really traded it exactly. Well, I have before. I did trade it, exactly as it was initially, but I've kind of, explored new things. But it started as my main strategy in the 90s. And then in 2004 and 2005, I did completed the CANSLIM Master's certification, which means I did all the training and everything required, but then also it passed the test. I had a couple of friends that went through it too, but they didn't pass the test or didn't bother to take it. So, but that was with William O'Neill, Bill O'Neill, and his portfolio managers. Well, I flew out to Santa Monica for, and did all that after you do all the online training and such. Overall, the CANSLIM methodology and the charting and the relative strength is what got me, and a quantitative screening is what got me into, more interested in technical analysis. As everybody does, you try to refine. I was actually trading it, so when you're trading the strategy, you're trying to refine it and make it better and improve on it, make it more yours. And because at the end of the day, that's really what you have to do, is you have to make it your own. It has to become your strategy. So my strategy is quite a bit different than that, but that's, certainly the core. And so I became something that I did. It was kind of interesting was I became really, really interested in technical analysis, and I became what we call a craftsman at point and figure charting. And that was with organizations like Dorsey Wright and Tom Dorsey, and then Candlesticks. So in the late 90s into the early 2000s, I was really focused on being a skilled craftsman, a technician, chartist, whatever you want to call it. So CANSLIM, there were some missing parts to CANSLIM. So when I got into, after I'd been, trading it for a while, there were some things that was missing for me. And so I started thinking about things like, what if I'd been doing this, in the past, before I even, and what really happened was I actually had a client who asked me, the nice thing about having clients, especially, larger clients that are, really involved in your business, is I had one ask me, how do you know this will work? How do you know you really have an edge? Because I would talk about things like edge and asymmetric and, returns and asymmetry. But so that kind of prompted me to want to quantify strategies and then be able to back test them and apply a much more scientific mathematical basis, because math, obviously my college education was accounting. So math is my thing. I'm a math guy, and wanted to quantify it and, and really, have a mathematical basis behind believing what I do and doing what I do. And so that was the early stage of it. Was, that came along around 2001, 2002, and we were in a bear market then, by the way, a major bear market for technology, especially. And fortunately, during that time, I was actually still a stockbroker around that time. Technically, we didn't call it that, but that's what it was. And and I was already doing relative strength ratios and things, and which was unique beyond the CANSLIM approach. This is more of something more of a Dorsey Wright point and figure charting kind of thing that we really did. Is, they really were the leaders in relative strength. And we were really comparing, like, on a macro level, comparing stock indexes to bonds, and individual stocks to stock indexes, and sectors, looking at sectors and ranking them. And back then, we actually would, the big thing in those days was trading sector funds. And you had Fidelity sector funds, and you had Rodex sector funds, and you had Pro Funds sector funds. And so that, during those days, sector rotation was something that people try to gain an edge at. And that's a whole interview in and of itself of how things were back then. But so CANSLIM was missing some things. I wanted to quantify it. And so I started learning how to backtest, and particularly hiring programmers, because I wasn't really a programmer initially. So I would hire programmers to test, and that actually led me to, that led me into more down the turtle CTA trend following path. Then I mentioned the turtle traders because I know some of them. And one of them, Curtis Faith, had published the turtle rules. I think it was in the late 90s. It seemed like it was around this time. It was on the internet, and I had found it, and there's some parts in the turtle rules that nobody else had ever heard of, and that was how they manage risk, how they size positions, and how they what I call now, which is more of an Ed Secoda thing, manage, portfolio heat, and your open risk and all those things. And so that was a real big thing for me, because at the time, I was advising, clients of, stocks and options and whatever to buy. And, and something I did early on because of the how to make money in stocks is I always wanted to do a stop loss. And that was critical when you have, you might have 200 clients that are, invested in one stock, and it takes, you can imagine trying to call, because we had, you had to call them. So you imagine trying to call 200 clients, tell them to sell something.
Right.
So you really wanted to so really, when I say predetermined, predefined, that's something I've done my whole career. And it was because in the early days, I didn't have discretion, and we had to, we actually needed to have, more or less a price target as well as a stop loss, just because of the way the business model, it's a very flawed, brokerage is a very flawed business model. That's why it basically doesn't exist anymore like it used to, because it had a lot of, missing parts to it too. And so, but I started quantifying systems, and we can talk about that more, but that's really key, is that something that's kind of unique to my history is that I started out as a technician, a chartist, active stock trader. And then I got into learning about money management, position sizing, and exits and all that. More of what the CTA trend followers were doing, but I'm down south, and I wasn't in Chicago, so being which wasn't much of an excuse considering Paul Tudor Jones was from Memphis and the others, but it just wasn't. I mean, going to the CTA route was kind of out there for me. So I was trying to focus more on the things, the area that I'd come from, which was stocks and options. And so anyway, I ultimately developed a complete system, which is now called Asymmetry, and a complete system being the key to that, which is, how we determine what to buy, how we determine when to buy it, how we determine when to sell a loser, when to sell a laggard, and when to sell a winner to take profits. Those are, the kind of the core parts to it. And so.
Perfect. And outside of the Turtle Traders and William O'Neill, you mentioned Ed Dakota as well. Were there any specific, trading traders out there that you really looked up to and you kind of modeled and like took some of their approaches and made it your own? I think in our pre-interview call, you mentioned Van Thorpe as well. He was a big influence. So
Van Thorpe, obviously, from the turtle rules, and in his first book, which I think come out in, it was actually out a couple of years before I knew about it. I probably knew about it in the early 2000s. His first edition, I think I got it around 2001 or 2002. In that bear market, I was very immersed. I was working for a big firm, but I was very immersed in trying to refine my strategy, 24/7. Van Tharp, I've done a lot of training with him, and it's both trading psychology, and of course he's, he trademarked, position sizing and all that. And so that's been the tremendous resource. Did his peak performance program, lots of pretty much everything that they've done since, for the last 20 years, I've been involved in one way or the other. And, obviously I'm friends with lots and lots and lots of other hedge fund managers, basically. And, there's a lot of us that talk, but, in the early days, those were the main keys that I knew then. And I think that, I don't really, other than the one strategy, and I mentioned, Dorsey Wright too, as point figure charting, which I don't really do that, as so much anymore. I've always enjoyed doing market analysis, and that's what I share on Twitter. On Twitter, I can't talk about my trades. We have, SEC rules to follow, and we can't, if you tweet about your trades, there's a lot more you have to provide. So it's, when I'm on Twitter, I'm just sharing my overall general, broad views of the market, which is market analysis. And, for me, that's just something to kind of do, while I'm doing my normal daily routine. But I have, but also have, my stock trading is more discretionary, although I do have systems. Mm-hmm. But back in the early 2000s, by 2003, I had developed an actual, more automated computerized trading systems, and they were applying trend, momentum, volatility, to markets. And something I had discussed with, I did an interview with Michael Covell in 2012, I think it was, for trend following. I was applying trend following, and I still do, to ETFs. Mm-hmm. And I was really very early in adapting that, because like I said, before there was ETFs, we had RIDEX funds and all these sector funds. And there were, I knew people that were trading them in, shorter time frames, but I was more momentum and longer. I'm looking to capture longer trends, preferably. And, but yeah, and then sometime around 02, 03, maybe, there was an issue with the typical mutual funds, and we called it a market timing or whatever, which I'd never done any of that, but there was that big issue, which made a big, that really is what I think caused ETFs to become more popular. Mm-hmm. And in commissions, so, you got to realize back then too, 20 plus years ago, we were dealing with, you're paying about $200 commission to trade 100 shares of just about anything, right. And your commission would be, it's full for a full service broker. And the commission would be depending on the price and all these things. But you're talking about a $200, per on each side. And so, you're very limited of how much trading you could really do. And so I was more of a position trader. I was more looking to capture the bigger trends and all that. But here we are today. That's what's so exciting now, to be an active manager and be an active trader. Guys like yourself that are doing it, now. I mean, your starting point is so much better than what it used to be.
Yeah.
Because we just simply 50 trades back in the back in the 90s or the early 2000s. 50 trades probably meant several $1,000s in commissions, which, if you're a broker, by the way, is a good thing. But in the brokerage days too, you had guys that you'd have a $10,000 or $20,000 day from commissions. So they didn't really, a lot of them, obviously, to be a stockbroker and be good at it long term, you had to make people money over, ultimately. But certainly the commissions were the driver for most of them. So that just, I was more the analytical.
Perfect. Yeah. And I want to ask you, what were some early mistakes that you made when you were just starting out as a trader? And maybe, there's one or two trades that maybe you lost a lot of money, or you just kind of learned a lot from. I'd love to hear some stories about that.
I think everybody has a few of those. I really learn from mistakes, and I mean, it's just something. I mean, I learn just in daily life. I rarely repeat the same mistake twice. And but I had a stock that I bought back then, and and it was, I'm not even going to say what stock it was, a major stock that everybody else in the world owned. And it went down 30-40%. Well, the crazy thing was, I put money in it that I kind of needed. I was wanting to buy a car later on. So I learned, I lost 30-40%, which, by the way, of course, if it were $10,000, it was worth $7,000. If you needed to buy a $14,000 IROC Z, Camaro in the early 90s, then in the mid 90s, is a big deal. You didn't really think about percentages, but I learned that, I kind of learned that way. And then I learned, fortunately, as a young stockbroker, you learn, you go through, thousands and thousands of iterations of mistakes. More, not so much me as it was the other people. And I knew pretty early on that I wasn't going to, stay in that role for too long, because it just wasn't very possible. You're not really a money manager. If you're working for a brokerage firm, you're really not they'll call themselves portfolio managers nowadays. But if the brokerage firm is, back then, though, it was, you didn't have discretion. So even just having discretion was a big deal. When I was at Raymond James, though, I actually got to where I did have discretion. And I also had, not only did I have discretion, but the reason I was a registered options principal, which is a supervisory, more higher level role, is I actually had the discretion to trade options, which was something they didn't do very often. There was maybe 2 or 3 people, I think, that had that. But I did have discretion for certain option strategies that I could implement with indiscretion on a fee basis without commissions, of course. When you can never have discretion with a commission, because commission's a broker. And so, investment advisory is not the same as brokerage. Investment advisory is a fee where you're earning a fee for it. But anyway, there's those kind of things. But I'll say that the frustration, I really wanted to be a portfolio manager, and the frustration of working with, trying to get clients to follow your advice, and seeing all of those, what we now call all these cognitive biases that are pretty well known today. If you read, Thinking Fast and Slow, and any of these behavioral trading, oriented books, all of that was things that we were learning in real time. And the behavioral finance and economics, what just simply didn't exist as a topic in the year, back in 2001. 2002. And of course, by the way, I also started, in a major stock market crash. So we had that, the massive waterfall decline from 99, or, from 2000 to 2003. And so I operated through all that. luckily, the challenge then, I was fortunate that I was already doing relative strength work against relative to bonds, relative to, it's very a global macro, type global tactical, global macro. So I had, I was shifting to bonds, but I was doing it at a time when clients would laugh, when their stocks are down, and you're wanting to shift to a bond fund or even individual bonds. And like I remember there was this one particular bond that had like an 8% yield that I was recommending clients to buy, sell stocks and buy. And they had just they were averaging, they would say, well, I've averaging 20-25% on my stocks in the last several years. Why would I buy an 8% bond? And so needless to say, I had a few of those that stayed with me all these years, and they certainly found out through that period. But the only reason I'm not an economist. I didn't, and economists don't know the future. They don't know the future either. But the only reason I knew to go to bonds was because of relative strength and the trend. Those trends were going up, and they were going up relative to the other things. And so that was kind of, a major, and in fact, I had a very large client back in, 2003 or so, who came to me. I was talking about starting my own firm eventually, and I was doing a kind of a, in again at a Raymond James brokerage situation. I was doing a kind of more of a core satellite strategy, where we had a strategic core and a tactical satellite, and I eventually got the discretion to be able to manage the tactical satellite, and I was doing better with the tactical part than what the core was doing. And the core was invested in, like 8 or 10, good, the best mutual funds out there, or separately managed accounts. And I had a very big client of mine say to me, why, well, if you do start your own firm, I think you should focus on what you do and leave all the other, and that kind of stuck with me. And to this day, we only do the active tactical money management. We don't do asset allocation and all those things that normal, because my firm is a registered investment advisor. And so, we can, we can do financial planning and all that. My wife is a very experienced and highly skilled wealth manager, financial planner, and has been for 25 plus years. And and she does that stuff for some of our highest net worth clients. But anyway, the mistakes were, it's just everything you can imagine, and could have wrote the book on. And anybody that was doing a stockbroker back in that day certainly knows. We all but not everybody necessarily learns from the mistakes real well.
Yeah, absolutely. And I also wanted to ask you a little bit about mindset and trading psychology, because I'm sure you kind of know what it takes to stay in business all these years and protect that. Protect your capital, manage that risk, and also kind of coming from a more military background, I wonder if that kind of had any influence on your style and how you go about, trading and viewing the markets in general.
It does. I mean, I'm 51 now. So, I think when you get, I've not had a midlife crisis. I've lived a midlife crisis. In other words, I've always been, enjoyed my life and everything, and always had, the cars and all that. So my midlife crisis is kind of not really a crisis, just looking back and reflecting on, how did I get here, And the Marine Corps actually did have a significant impact on me, more so that I know now than I realized at the time. Discipline being key. If there's anybody that goes into the Marines, whether you're in there 3 or 4 years or whether you're in there for 20 years, discipline is the big one, and it's self-discipline. They teach you the ability to be a trigger puller, to pull a trigger, and which means self-discipline. And self-discipline means that the ability to do things that you normally wouldn't do or wouldn't want to do. And so that's a big part of it.
Hmm.
And there's a lot to that. The other thing though is that it also made me, as I was originally going to join the Navy and be
Hmm.
an aviation electronics technician, because I had the ASVAB score to have a high tech job in the Navy, and that would have been, that would have been more of normally a career thing. But I changed my mind and I shifted to the Marines, and I just decided, my family history all is extensive military history. I had an older brother that was a Marine, but the Marine Corps was scary to join. I mean, the fact is, when you go in there and there's 4 offices, and you walk into different ones, the Marines were different. You looked in there, and they had the ghillie suits hanging on the walls, a lot of camouflage, and they had this certain look in their eye. They call that the 1,000-mile stare. So I just decided, if I'm going to go away and do this, I'm going to go ahead and switch to the Marines, and that's what I did. Well, that is so that I think is where my tactical operator comes from.
Hmm.
I think that the kind of person that goes into the Marines or goes in the Army and becomes a Ranger, or maybe the Navy, and go into the SEAL training and all that. I think that tactical operator thing kind of comes out in you, it sticks with you. And I had a bad injury, and I had to get out earlier than I wanted. And so I actually became, even though I had a service connected disability, I actually and I mean, I'm an actual disabled veteran. That's one thing I've never said, and I don't really talk about much, but I am. I mean, it's uh, you can go in and have a bad thing happen and come out and really press forward and make the best of it. I went through college through the vocational rehabilitation program through the VA, because I was, because I my injury and everything. So I think that when then I went to the sheriff's office. The sheriff actually asked me to come and work for him.
Hmm.
He knew who I was, knew the story a little bit, and in the early '90s, and said, have you ever thought about law enforcement? I said, well, no. But so next thing you know, I spent about 4 or 5 years as a sheriff's officer while I was going to college. So I did that full time. I did a normal sheriff's officer at night, and I'd go to school during the day, and then sometimes I did evening classes and worked during the day. So, but I was a sheriff's officer, and I was, a little more on the, more interested in the tactical stuff there as well, as opposed to the typical. So, yeah, I think those things do have an impact, and but I think self discipline is probably the big one, because self discipline is one of the most important things in trading.
Yeah, absolutely. And going back to your background, I actually want to talk a little bit now about kind of the back testing process and putting quantitative facts and figures, risk management, all of that, because I think that's really interesting about your story, and I'd love to hear kind of what you found out when you went back and studied the CANSLIM system and how it would have performed going back in history. So I'd love to hear about the process, as well as the overall results from those studies that you did.
Yeah, well, I will. Like I said, I got to a point where somebody had said to me, how do you know, we're talking about an edge and all this, and keep in mind, I'm a math guy. So I was doing a lot of, always looking at the math of gains and losses, and the math of position sizing and position size algorithms, a lot of the stuff that Van Tharp, I think, popularized, which really, I know where all that came from. It came from a few people, prior to that. The certainly the CTAs, the stuff. That's where most of that came from. But um, I really wanted to quantify, and so So here's something that's really interesting about me, is because the only other interviews I've done, which has been 10 years ago, where trend following, or Top Traders Unplugged, the hedge fund, you know uh, there you're more focused on the systematic side of things.
Right.
And so what I have is I developed about 30, start out around 35 different systems that we created, back 2003, 2004, 2005, around in there. and I started my firm in 2004 and really started managing outside money in early 2005. I went through about a 3 or 4 year incubation period where I was, where we was developing testing and all this. And I really wanted to get it pretty automated, and I still do.
Hmm.
I think that, you kind of want to be as automated as you can be. But what's interesting that we can have a talk about is I'm a quant amongst the professionals. In the
Hmm.
professional world, I'm a quant. I do systematic trend following, systematic momentum, and all that. Uh, but when it comes to my stock trading, the individual stock trading, there are no quants that have produced the kind of returns that you can with a discretionary basis, and it's been like that for decades. It's there are some things about developing systems and systematizing that maybe the machine learning and artificial intelligence, which is what we work on now, maybe some of that will eventually be able to do it. I do think that there are firms that are doing that successfully. But, really, like most of the people I think that you're talking to are discretionary stock traders. If they have rules, and you could take, it's well known, there's a few of them that have books out and they got all the rules laid out there. You should be able to take those rules, test it, and create a system. Okay. But why is nobody doing that? Why do you think? If somebody is say the guys that, the U.S. investing championship, putting up 200, 300, 400%, 100% a year, and they're not necessarily doing that every year, obviously, but why do you think that we don't just develop a system to replicate what they're doing?
Yeah, I think because there's still an intuition element to it, and I think you can pick two different charts that follow the system, but there's still going to be that kind of that mental side of things where they're able to pick the best idea based on their process, but they can't exactly write it down what exactly they're seeing, but based on their experience, that's why they go ahead and choose that, and that ends up being the bigger winner.
Yeah, and so here's what you do for somebody who I've gone so far as to have NLP experts, neuro linguistic programming person set, and as you go, you can hire an NLP person, an expert, and there's plenty of them out there that do trading, to do that just for trading, and you can have them spend days with you while you're doing your trading. And your goal would be the NLP person can figure out what you're doing, because that's what Van Tharp was an expert at.
Hmm.
He's passed away this year, but it's their goal is to kind of reverse engineer what you're doing and figure out what you're doing, because the fact is we don't always know what we're doing. When you're looking at discretionary markets, if you're sitting and spending I spend a lot of my downtime in the middle of other things, looking at Twitter and chatting with people about the markets and, whatever. There's things that you see, and something that has been unique for me, that I've added to trend following momentum, is the sentiment side of it. So I say that I'm following trends, and I'm going to say a number 95% of the time. It could be 80% of the time. It's going to be different depending on the conditions. But probably at 95% of the time, I'm a trend follower. I'm following the trend, just riding the trend, because it's going up or it's going short something going down. I'm following the trend. 5% of the time, which could be as much as 20% of the time, depending on the time frame, markets are drifting to an extreme. So what I believe is that I believe trends, especially in the stock market, commodities are different. Currencies are different. Commodities are supply and demand of the commodity itself. Like oil is going up, largely because there's a shortage, and there's also still demand. with stock market, the stocks are a little different than commodities, and I think that's why a lot of the CTAs don't mess with stocks that much,
Hmm.
because they are a little bit different markets. Not to say that you can't apply the same strategies, but there's some differences. Uh, One is, an early morning gap down over an earnings report of 30%. You don't see that too much in commodities. So, or in a currency, certainly you have, currencies are counter trend markets. There's no reason to believe that the euro will go up forever against the dollar.
Hmm.
There's no real basis for that happening. Now it can trend up over time, but what they tend to do instead is the currency markets tend to oscillate, so they tend to be a little more mean reverting, and they cycle from highs to lows. Well, so stocks tend to underreact to information. They tend to underreact to information, and as the information becomes more out there, stock market investors will figure it out, because we may all have generally the same information today. Um, and but the thing is, we don't act on it at the same time. So I think that the reason that you see prices trend from 50 to 80 over some time frame is because the investors are just they're reacting to it longer, and the big institutions are the ones that are that are really driving the price, the multi-billion-dollar funds, and so they're accumulating over time too. So there's a lot of that. But what happens is, and the same applies to the downside, although the markets do crash down faster than they trend up, and there's good reasons for that too. But while the market probably underreacts to new information and trends, I don't know, 80, 95% of the time, whatever, the rest of the time, at other times, and like I say, about roughly 5% of the time, they get to an extreme. And so, stock market will get to an extreme overbought condition or extreme oversold condition. And when it gets to those extremes is where I change gears a little bit. If I may start to hedge a really deeply oversold up or overbought uptrend. I may hedge in various ways. I can use short, the SH short ETFs. I can, use options or whatever. I can go long volatility. I may start to kind of hedge off the increasing likelihood. And my trend follower friends hate it whenever I talk about this, but hedging off the increasing likelihood that that it's going to have a nasty reversal, because those reversals are usually pretty rough. That I try to do it in a way to where I don't miss the parabolic move on the upside. But in the stock market, it's just different there. I mean, the commodity trading, the CTAs, their markets will go parabolic, and I mean, like oil, for example, it'll just keep going it'll get silly, and the stock market can too. But those markets do it a lot, and most of them are trading long and short 100 markets. The stock market, though, when it gets really, really overbought, you're going to get a decline at some point. And so I got a lot of ways of how I identify those kind of things. And when that happens, I go from, having to come back and, get in front of the screen a little bit. When I'm following trends, I go get, hang out in the swim pool for an hour, but, or, go for a longer walk. Cause that's easy. Because remember, my trend following momentum, all those things are very systematic. They're automated. They're trading programs, but it's the counter trend. So I'm a trend follower and a counter trend. I do both. And the counter trend is, again, roughly 5% of the time. And it's really more sentiment based. It's to exploit those overreactions, where the market has underreacted, but then it starts to overreact. I mean, we get overreactions on the downside. And so I will take some positions, in a waterfall decline. I mean, like, this year, for example, I mean, we're positive for the year, and, we're in a position of strength. So when the market, had that waterfall, that we've had really two pretty heavy some selling pressure. You know, 1 or 2 Fridays ago, I was buying into that close, that waterfall. And so I was adding some exposure because that's my counter trend system. My counter trend system, though, is my discretionary. While I have, a lot of systems for that, I'm ultimately kind of making those decisions because I believe counter trend is more risky.
Mhm. And
Mine
Mike,
until,
could I ask you what indicators you're looking at to kind of determine, when we get kind of stretch either to the upside or the downside?
yeah, I tell you, it's the same things I've been looking at since the late '90s.
Hmm.
Back then, we did, Dorsey Ride and some other investors intelligence. Both there's two different research companies that had bullish percents. So the point and figure charting, one of the big things that's been around for decades and decades is to take where they take the sectors, we would take the sectors
Hmm.
and you have what percentage of those stocks are on a point and figure buy signal and what percentage of stocks are on the point and figure sell signal. What happens over time is in the stock market in sectors is when those markets get really washed out and all of them, if there's only 10 or 20% of the stocks in the financial sector that are on a buy signal, at that point, most everybody has sold.
Hmm.
It's, and so you're looking for it to start to, you're looking for that capitulation. You're looking for, and so that's an example. I actually started using, rather than point and figure charts, I use the percentage of stocks above the 50-day moving average, 20-day, 100-day, 200-day. I've got systems that monitor all that, and they go ding, ding, ding when something's getting at a point that I want to see it. And right now, this looks to be the early stage of a much bigger bear market, most likely, unless inflation drops, and it very well could, by the way. So I'm not calling it, a crash yet, but because it's going to just unfold. I did very well during the 2008, 2007, 2008, 2009 period, and I traded those swings, and a lot of it was things like what I'm talking about, which is knowing, the internal breadth. But also, just the basic, the RSI, relative strength index, and doing that over even different time frames. Oversold is oversold, but it's really more of a combination of those things. It really is, the percentage of stocks above or below moving average, which, by the way, as a math person, and I've quantified a lot of it. I mean, I've tested this and quantified it, developed systems to be able to analyze it, to know what works and what don't. And these are extremes. It's when the markets get really, really. I wrote something that was real popular that I wrote. I have a blog called Asymmetry Observations, and in late 2018, I shared some pretty deep missives on the breadth of that big decline in December of 2018, and markets get down to where they're really washed out. But the opposite is also true.
Hmm.
I've been able to manage a lot of risk by paying attention to what all the individual stocks are doing, and how many of them are already in uptrends. So if you go on my Twitter, you'll see that when I post those, I often will color code the top red and the bottom green. And I'll explain why I'm doing that. And that again, that goes back to something that, we've been doing that for 20 plus years. I have literally been monitoring those indicators for a very long time, and so a lot of it is intuition. We have been unable to create a program that will replicate my intuition.
Hmm.
We've been unable to do that, and that is going so far as to have. I've really had people monitor what I do and how I think and what I see. And until we can get artificial intelligence and machine learning to where it can, replicate some of that. and I think we'll may get there one day, because obviously there's nobody that wants to automate and quantify and automate, my strategy more than me. Even though I do enjoy it though too. See, that's the other thing. I enjoy doing some of the discretionary stuff, and
Yeah.
I enjoy the process of trading. I've been in love with the process of trading for over 20 years now. Um, so I do enjoy doing it. But I will tell you that a lot of your blow ups from people over the years, you're talking about longevity, the blow ups come from people getting, they go astray. Self-discipline issues every time. One of the best things you could do is just study all the self-discipline books out there. And I notice I'm saying self-discipline. Discipline itself is not enough. It's self-discipline. It's the ability to make yourself do things that you may not even want to do. And I have a lot of that. I really am able to execute, pull the trigger without hesitation.
Mm-hmm.
And I don't have, in the early days, I had the feelings of, oh man, I had all those feelings back then. I still have the feelings, but I have accepted them. And so when the trading psychologists, and there's some good ones out there, they'll talk about that a lot. You got to, I say a lot, I kind of taunt some of my quant friends that are, completely automated, more systematic. And I'll say, you're going to feel those feelings anyway. It doesn't matter. You can't back test your way out of it. You can't test your way out of it. You're going to feel those feelings. And if you think you're going to develop a system that's going to eliminate the emotion and remove the emotion from the equation, as I see all the time, those people are amateur rookies that have not yet quite experienced what they're going to experience, because you will. And it's harder. Systematic is harder than discretionary, because with discretionary, you're making the decision, and you're generally going to own it. You have to own it too, by the way. You got to have personal responsibility. That was another major Van Tharp thing. Really, I've always taken personal responsibility for myself, because I had no other choice when I was young. I just didn't, and you have to, when you blame the markets for your losses, and you blame the markets for whatever, and other people, CEOs, whatever it may be, you're giving them the power. You're handing them the power to create your life, and nobody does that for me. No human being does that for me. And I'm going to make my decisions. I'm going to get what I want. I'm going to do what I do, and I'm going to take responsibility for it. And I mean that real, very. I've been in lots of situations, and contentious situations, but in business, other business matters, where I say what I'm going. I do what I say I'm going to do, and I back it up, and I'm willing to back it up, and more harshly probably than most people. So. Personal responsibility is big, and I hope I answered your question.
Yeah, you did. And I also want to really focus on today on position sizing, because I think there's a lot of focus on the entry points and getting the perfect entry point, but what I've kind of learned is it doesn't really matter if you get the perfect buy point if you don't have size enough for it to matter, and it also comes into risk management as well. So I'd love to hear your thoughts on position sizing, because I think that's an area that people don't really think about until they get a little bit more experience with it. So I'd love to hear your thoughts on that.
It is, and and again, I tell you, that's the single biggest thing that we see on, but we follow each other on Twitter. It's the biggest single thing you see out there on Twitter. Twitter is all, for me, it's all about sentiment and behavior. I'm just noticing behaviors. I actually, and I'm going to kind of go off track from what you said in order to lead up to answering that. The position size kind of question. I see people, it's like everybody's trying to figure out what's going to happen next. I mean, if you heard, I was the fourth interview that Michael Covell did on this trend following podcast. And I talked about that a lot then. Everybody, it's like everybody's trying to figure out what's going to happen next. And I'll tell you, I'm going to show you something on the screen that'll kind of hopefully bring that home for anybody watching, because I just want to help people get through this, because we're going, this market condition is going to see a lot of swings, and there are going to be some radical swings probably, because this looks like it may be the big one. And again, it may not be. If the inflation drops, I think things could go, we could see, new highs, so it's just going to unfold over time. But let me say that the position size and the risk management is such a critical thing. And I'm one of the people that has been saying that for 20 something years. If you ever heard people talk about how somebody's saying, that you could throw darts, and, my money management system that I've been operating for, 20 or so years is robust enough that it extracts the trends that I want from whatever you hand it. Okay. That's what my methods are designed to do. It's like Michelangelo taking a big block of stone and chipping away. The market provides you with trends, and you want to feed it as many. With my systems, I want to feed it as many trends as I can. And and you want to take the waves. When the wave comes, you want to get on that wave and ride it. Let me to answer to get into the position size thing. Let me show you I've got just a couple slides here.
Perfect.
That'll, I'll show it to you rather than just tell it.
Yeah, that's perfect.
So before that, you told me, you wanted to talk about my asymmetry, overall programs. So asymmetry for me, everything revolves around asymmetry. That's why I trademarked the word over a decade ago, and for the use of in investment use. And asymmetry is all about the pursuit of asymmetric investment returns. And asymmetric investment returns are risk $1 to earn $2. It's all about less downside, more of the upside. We want to participate in less of the loss. We want to capture as much of the gain as we can, and that is a beautiful thing. And that has to be asymmetric. And I'll tell you what's funny is that the interesting thing about asymmetry is that most things in life everybody talks about balance. And I said way back when I was, a professional, becoming a professional as, at a brokerage firm and an advisory firm, they talked about balance in the portfolio. They talked about balance and risk and reward. And I mean, I hear that all the time. You want to balance your risk and reward. You want to balance your portfolio, and it's completely the opposite. If you balance your risk and reward, you're going to have symmetry. You're going to have profits that equal losses over time. And what it actually looks like in the market is like this. Over time, you have symmetry. You'll have periods. Think about what the S&P looks like over the last 20 something years since I've been involved. You got you got periods where it goes up and then it waterfalls down, and then it goes up and then it waterfalls down. Well, that's what happens when you balance your risk and reward. What you really want to do, or what I want to do anyway, is I want more of the good thing and less of the bad. And I mean, that's inside of me. It's a personality trait. It's something that I've just always done. I mean, even when I was riding bicycles as a kid, I thought that way. I mean, I could tell you a million examples. So it's all about asymmetric risk reward and skewing the upside versus the downside, asymmetric payoffs. Mm-hmm. And I'll tell you that I'll get into an example here, but we cannot ever control our upside. Doesn't matter how much research you do. Doesn't matter, what kind of signal you've got, how great the predictability of the buy signal is. Most people are focusing on the wrong thing. They're focusing on trying to have more wins and all that. And that is just not so possible, because everything that you do to increase your win rate is most likely cutting the win the amount you win when you win. It's cutting it down. Because if I want my win rate to be really high, you'll take your profits quickly. Because hey, if you just want a win in the win column, you're going to take profits too soon, because you don't want it to become a loss. If you if you want your win rate to be really high, you're going to ride your losers, and that's the biggest mistake you can make.
Yeah.
The biggest mistake I've ever made, and I've made it a couple times, but nothing devastating, fortunately, because of the risk management that I do here, which you'll see. The big is sometimes the only time I've really done it, let a loss get worse than it should have been, is I'm trading a vast amount of ETFs. Most of my systematic asymmetry programs are trading ETFs. Mm-hmm. And there's, and that's sectors, individual countries, commodities, currencies, you pretty much can do, just about everything in ETFs now. And early on it wasn't the case, but now you certainly can. So asymmetry is the upside versus downside capture. Asymmetry is also, though, more than anything else, it is a positive mathematical expectation.
Right.
It's funny. I have been very. I started writing a book actually in I think 2011 or 2012. I had a book contract with Wiley Trading, Wiley, and I never did sign it, and I never did actually commit to doing it, finishing it up, because I was busy doing other things. But I do need to do that one day. But this is really what the book would be about: is this page right here, because asymmetry is a positive mathematical expectation. And the reason I say everything revolves around asymmetry, in order to have asymmetric investment returns, which means, so you think about asymmetric investment returns, your drawdown over, I've been doing this for 20 years, your drawdown is less than your upside. So this risk adjusted returns is kind of the more traditional way of saying it, but I look at asymmetry ratio of everything. What's this worst case? If I'm looking at an ETF, I say, what's this worst case drawdown it's ever had? That's because that's your risk. It's not standard deviation. It's the drawdown versus how much upside has it had over time too. So that's asymmetry ratio. So everything is focused on that. But when it gets to mathematical expectation, there you're talking about the percentage of wins, times the amount that you win when you win, and a percentage of loss, the percentage of time that you lose, which is the probability, by the way. So it's the probability times the payoff. The probability times the payoff, and you subtract those two things, and you have an expectation. And so when you're developing systems, you're looking for a positive mathematical expectation over the system over a very long period of time. So I was testing going back decades. And when we were doing, because I was so early with the ETFs, they didn't have a lot of data back then. And so I actually was testing with the actual index data back then. And I've said before that I actually even went so far as to create trends that never existed before. We would take data and chop it into pieces. Say if you took, this is just a overly simplified example, but say you take the S&P 500 index data and you broke it into months or quarters, and then you use Monte Carlos to scramble it and then spit out 1,000 different Monte Carlo examples, and then run this. This system is a system that determines what to buy, when, how much, when to sell, or loser, and a laggard and a winner. So when you run that data through it, it's going to spit out something in the other end. And so that's how I developed robustness. Mm-hmm. And and you also learn a lot about imperfection, because the hard thing about the quantifying things is that you learn that a lot of things don't work like you thought they would. And there's also a lot of periods where they just don't work as well. And so you can either, what I've done during those times is kind of play a shell game, no pun intended, but I've got all these different systems, and I can determine which one I want to run it and when, because I used to have, after 2008, 2009, the financial advisory world was looking for somebody with a track record like mine, because I had a very nice track record, during that really difficult time. But some of them wanted you to do it systematically and, or more automated, where you disclose the details. And I never would do that. I never could. I probably would have made a lot of money if I had done it, but I was never quite want to put my name and my trademarks on it if I couldn't make changes and make my adjustments. Because you see, a provocative statement is that there are no systems out there. I don't think there's anybody out there that had been running the same exact system for 20, 30, 40 years. I don't think there's anybody that has back tested and developed an automatic trading system that they've been running the same thing for a long time. I have been doing what I do. It's amazing how when I sit and just put it together, this little PowerPoint, how I reflect on the past. And at the end of the day, 80% of the time of what I do is what I was doing back then. I'm just a lot better at it. And I've got a lot more robust ways of doing it. And I've tested it and quantified it, mathematically verified it to where I have a mathematical reason behind doing everything I do. Mm-hmm. And so with that said, I'll go to the next. Here is just a very idealized, overly simplified slide that we used. In fact, I just noticed that it says the chart itself's got 2015 on it. I don't present to investors too much anymore. We got a client base that's been with us a long time, and we don't really do any marketing. But this is an example of active risk management. This is actually part of the presentation that I did for Folio Institutional that back in 2015. But and this is going to be, I believe that this stuff pretty well, but I'm going to really press on a few of these things in your audience. So, the way that and this is just an idealized, simplistic way of looking at it, and there's a whole lot more advanced stuff that goes beyond this, and I'll talk about some of that too, but this is the key. And I want to use it, and this is one of the reasons that I agreed to do your this interview, is because we're in a difficult time, and I know a lot of people are struggling, and so I want to. This is the biggest thing I can show people to help. Mm-hmm. So when I get into something, and here you can see you can probably see my mouse, hopefully. Yep. Here's the $50. This is just completely an arbitrary, it's a strong uptrend that's started going up, and say we're going to buy it at $50. And we predetermined the loss at say $45. So really, and that would just be, so we're right here. So this would be that prior low, and actually some part even some, even below that. And don't let me forget to tell you that part, but just idealized, that's what it might look like. I'm going to buy something at 50. Before I can buy it, I have to, in order to position size properly, I have to know in advance when I'm going to get out. Right. And so it could be 45. That'd be a 10% decline in price. And then of course, then after it gets underway, in this case, it looks like it took a dip, and then it, trended up, and then it trended down. Didn't sell the top, but down here somewhere. So the second part to it is, I say when, how to determine when to take profits. That's what I call portfolio management, is getting into, some people call it position management, but getting into what do you do after you're underway, because it's not as simple as doing just the first part. You do have to do the second part, but I'm going to focus on the first part for now. So, I'm buying at 50, I'm going to get out at 45. And that's based on the trend. That would be a trend break. I also have the word range. I said to remind me, I got it in there. The big thing, you hear a lot of short-term traders talk about using tight stops and all that a lot. And in a lot of cases, you can do a tight, really. I've never known anybody that's done really well for a long time that's doing tight stops. The reason is because if you're only given, like we're just this example, I'm using the 10%, and that's just just happens to be 10%. If I had set that at 2%, guess what? That little dip right there probably would have taken me out. That little dip might have been 2 or 3%. What happens is, what you have to do when you set your stop or you set your exit, I call them exits because I don't actually put in stop losses. As an institutional money manager, we enter our trades with Goldman Sachs, and I have certain windows that I do that during a day. We can't really just go in there and tip our hand to the market makers and put a stop loss for 200,000 shares or whatever. So I have to pull the trigger. But if you put your stop too tight and you're within the normal noise in the market, you're going to get stopped out all the time, and your loss ratio is going to be really high, and there's going to be a couple times you're going to take a beating, and it's just foolish to do that. You really got to make sure that your stop loss is outside of that normal noise to give the position room to run. And the way that you do that is a multiple of ATR. You do the turtles. That's where that comes from. And Richard Dennis and Bill Eckhart. If you think about just the standard Wells Wilder 14-day, he used a 14-day average true range, which is an average of the true range. And, that's just taking the highest high versus the lowest low over that period of time. You can use different, if you're a shorter term, you probably should shorten up the window because 14 days sort of implies that you're really looking at a 28-day span. And so, you can shorten it up, but you really want to be outside of that normal noise of the market. And that's really critical. So, I would never put a stop in. So if the ATR percentage is, like right now, the S&P is actually at like 2%, meaning that the S&P 500 is actually intraday and high, it's moving around 2%. That's really high. Yeah. Based on his history. Most of the time it's well below 1. But if you were to put a stop in, a really tight stop, you're just going to get stopped out, so you really want to go like 2 times that. So if the ATR, is 2%, then I like to normalize everything into percentages. But, you really want to do like, say, 4%, because you really want to give it some room because, I think it's really critical to have your exit outside of that noise. I also think it's critical to have it outside of where everybody else is looking. So notice this is completely an example, but notice that line is further down. And so that line is going to be a combination of not necessarily wanting to be, where everybody else is, plus, some ATR, multiple of average true range. And so anyway, there's that. And that's really important. I mean, was that something familiar to you that you think you see people doing it a lot, using the?
Yeah, I've a couple of the traders who I've talked to use ATR to set their stops and also size their positions. So, but I think it's a really critical concept that most people probably haven't heard a lot about, and it's not written in many books. So I think it's a valuable thing to learn. And even if they don't use exactly what you've talked about, you can find your own way to use that same kind of strategy and way of thinking. So
it's really critical to use both. In other words, I know that some people use ATR, like 2 times ATR, and that's just their stop. But you kind of actually, what you're really trying to, if you're following a trend, this is a trend following example right here, kind of looking at it more in a discretionary way, because the systems, with systems, you're not looking at the chart, it's just doing it for you. But it's really critical that you hopefully identify an area. And as you know, this is a really rough example too. That actually was I think a long-term treasury index back in 2015, if I remember correctly, but it's a little volatile. But most of the time you've got a nice flat base that you're buying the breakouts. Well, that flat base, if it goes below that flat base, it's probably not going to hold. So it's good. It's important to use some area where there's been a lot of action before, and if it goes below that, you're probably going to lose a lot of interest in the stock. But then also have it outside of the ATR thing. So finishing that up, then say you got $1 million. I used $1 million only because this has been used in our client presentations years ago, and our minimum is $1 million. So say we're risking 1%, and I see here again, we're going to get into a little bit of detail, because say I'm risking 1%. Now I'm going to have to say to you that's just arbitrary, because unless you have tested your system, you don't know what that percentage should be. And there's two ways you can test it. One way is you can, if you're back testing a trend momentum system and it's going to be completely automated, then you're going to be able to make all kinds of, you're going to be able to adjust and see what works better and all that. You don't want to make it perfect either, because if you got it too tight and it looks too perfect, you're going to end up on the edge of the cliff. What I call them, and I'm visualizing this diagram that we create when we're doing this, but you want to be on that flat surface up at the top of the mountain, and you want to be in the middle of the flat surface, which is not going to have the risk and reward. It's not going to have the best return and all that, but it's going to be a safe place in the top of that mountain. If you've ever seen the results of a back testing where it's doing like a multi-parameter stepping and all that, it's got the colorful mountain looking diagrams. You're looking to be in that flat area, not on the edge of the cliff. 95% of people would want to be there on the edge of the cliff, though, because the edge of the cliff is going to be that little peak where it's probably not ever going to do that again. So you have to be very intellectually honest with yourself about where to be. And I have tended to be conservative, very conservative on those kind of things.
Yeah, it's about building in safety factor and adding robustness. Exactly. Yeah.
Exactly. Yeah. You want it to be, you're looking for the area where there's a lot of other parameters close by that would have also worked. Mm-hmm. Not looking for the perfect parameter. When you see these perfect charts back tested, they've gone for all they've done is sit and data mined and created something that worked in the past. And it's just certain, it's 99% sure it's not going to work in the future. You have to do it in a way that's, there's a lot to that. I mean, that's really critical. And I think that's something that, is really critical there. But there's two ways, though, that you can determine how much should you be risking, mm-hmm. Because it's really a calculus. It's a calculus formula, basically. But one way is, doing it via testing, which is what I did. And another way that you can do too later on as you develop more and more trades is you can go and actually look at your actual trades. So your discretionary stock traders, the William O'Neill type stock traders, they would go and take their historical trades, and then you could, then you apply calculus and you simulate, you determine at what, how much you should be risking, in each position and all that. And because what you're trying to do is avoid the blowups. And, the problem with a lot of discretionary traders, we saw, YouTube video just recently of one that talked about his, he's had blowups. And I was kind of surprised here that I actually met him at the William O'Neill class back in 04, 05. But yeah, people, you're a human being. So you have to, you have to realize that you're a person, and you're going to go through all kinds of things in your life, and there's going to be things that can mess you up. And, I've been fortunate that I've only been married one time. I got one son, and, I've had a very stable, although we have a lot of fun, we enjoy ourselves a lot. I've had a very stable, life, but also didn't get married till I was 41. So, and didn't start dating her till I was 36. So I got a lot of the fun stuff out of the way, but the percentage, though, it really needs to be quantified and to determine, so that's really important. And I know a lot of people throw out arbitrary numbers. I mean, you're really aggressive position traders are trading, if you're putting up a 300%, return in a single year for the U.S. Investing Championship that they started back recently, those guys, we know what they're doing. I mean, they're betting 5 to 25% in each position. They're running 4 or 5 positions at a time, which is what I did back in the day myself. And I actually, will do that sometimes still with my own money, though, not in our investment program. Just it's hard to justify if you do that for other people. You really got to do it in a private fund. You got to disclose the risk that they may lose everything, because it can happen. But even though, we get very confident in our risk management, but we know that if you really want to put up big numbers, the key to that is having 20 to 25% in maybe 4 or 5 stocks, even fully loaded. Even if you are fully loaded, you may not even be fully invested all the time. Another key factor about math is, you don't necessarily, when you do that, you don't necessarily want to be fully invested at any time. You may just be trading one stock 25%, and maybe you find another one later and you throw 25% in there. So, because you're really just trying to take advantage of the compounding of the capital.
Right.
And again, that's asymmetry too. That's it's the exponential nature, the asymmetric nature, the geometric nature of the way performance is calculated. An advantage of being a professional and having your performance, calculated, audited, and all that is, I know how time-weighted return works, and you can easily, when you understand how that math works of compounding and how you don't want to go backwards, you want to try to always be going forwards, and then you can run a more of what I call a big bet strategy, where you're taking much bigger positions and much more focused. But we also know you're going to have 5 to 10% down days sometimes if you're doing that. It's just going to, it's going to be part of it. But if it's your own money and you're the only person you got to deal with, then, that's not such a bad thing. So anyway, so we say 1% idealized, that would be $10,000 in the position. And that's, just the simple math. And so $10,000 predefined risk divided by $5 at risk. So so 1% of $1 million is 10,000. Okay. And then divide that by the $5 at risk in this particular example here. And that comes out to be buying 2,000 shares. And so then what you're actually going to be, that's what you're going to plug into your brokerage. Now, in my world, we're using percentages. We don't, we enter a percentage of how much position size we want. And we have, our broker, Goldman Sachs, is an institutional division of Goldman Sachs, actually handles, their system handles all the back office stuff, which, determines the number of shares. I don't get involved in that. So it'd be 2,000 shares of $50 position. That's $100 or $100,000 position. That's 10%. That's 10% total position of the portfolio, but it's only 1% actually at risk. So if we were to lose, if it were to go against me, then the risk, the actual loss would be 1% at the portfolio level, would be 10% at the position level. All that's, this right here, by the way, when I did this presentation in 2015 for a group of professional money managers, I mean, this is not stuff that people actually know about. I think that within your group that you're involved in, because one of the guys that you're with is a, I think you guys probably know some of this a lot more than a lot of people do, but you'd be surprised. And I was doing this stuff way before. This stuff was like, this is what excites me the most about it. But and when I kind of, when I do it on a dry erase board, I think it kind of clicks the best.
Yeah.
When I've had people where our clients know about this, and, and I get excited about, and I get really crazy with the dry erase marker, but I go through and show all kinds of examples, just, but here's the real key is that once and I've been thinking about this a lot, and this is kind of this particular piece right here is what I really want to share the most right now, because I can kind of tell that it's amazing to me how many, you could tell a lot of people are sitting around watching markets and trying to figure out what to do next and what's going to happen next. And they talk about, they're just looking for that perfect setup and that perfect chart pattern. Notice I'm not talking about chart patterns. Now I have pattern recognition, and I have, I've been looking at cups with handles and double bottoms and all that for, 20 something years, every day for 20 something years. But But at the end of the day, all the patterns can add an advantage, and you can do pattern recognition and back test it, by the way, and you know what works and what don't. But there can be some edge there, but at the end of the day, you kind of just want to predefine where you're going to get out and let it rip. Um, you at the end of the day, you just want to determine, how much am I willing to risk of my account to see if this trend is going to unfold, and go in the direction I want. And you have to pull the trigger and let it rip. And I think that's probably the number one thing I can tell people is I think that there was a lot of hesitation out there, and really, and I also don't scale in and scale out much. And I hear scaling a lot within the O'Neill, the CANSLIM kind of strategy. You hear a lot about scaling. I've just really not scaled that much. I did in the early days because pyramiding was part of it. But the thing is, if you're adding to your exposure as a price is going in your favor, obviously you've been better off doing it before. You know what I mean? And so here's how you correct that: is you get this right here, what I've got on this screen, you get this right, and you don't have to worry about all that. I tend to go big early. A friend of mine told me a joke a long time ago about his college days going to the bar, and he said they would go big early. And I won't get into what he meant by that, but he said they go, and I've always it's always been a funny little thing that we've laughed about for years. And so I tend to be more, I want to go ahead and take my position early. And if anything, peel it off, I'm more likely to scale out than I am scale in. Mm-hmm. And so the key is to predefine the exit and to cut the loss short and determine how you're going to, how much you're going to risk there. And as I put here, it could be a prior low, a moving average, a percentage of ATR, or some combination of the above. I personally think you need to marry the ATR, percentage ATR with the others. It could also be point and figure charts, by the way. There's one of the William O'Neill guys that's been, doing with him for 15 or so years. It uses point figure charts now, because he and I met like in 2003, I think it was, and I was showing him how I use, that we had a talk, and I showed him how I use point figure charts instead of bar charts back then. And the reason I did that is because point and figure charts, the X's and O's, have some of the best stop loss. Those areas are so well defined, and it removes a lot of the noise, and it just makes it really clean. And it's one of the best ways. It's complicated looking, mm-hmm. and it's different to learn. But that was a really good way to define exits. But moving averages are good too. But so once once you determine your exit, then there's your calculation, and here I changed it to 1% at risk, 5% to the exit. It's a tighter stop. And what did it do to the total position size? It goes up. And this is the essence of what's really important about portfolio management, is that, if you have a tighter stop, you're going to end up with a bigger position size. Because your percentage of risk should be the same in your portfolio all the time. I mean, you really want to normalize what you're really trying to do. And this goes back to the CTA trend following the turtle traders. They were looking to normalize how much risk they took in each position and give them equal opportunity to go up in true terms and risk reward terms, mm-hmm. as opposed to just the position size itself. Because here on this page, I've got an example of a 5% tighter stop exit, and in the prior one, it was 10%. Well, you're going to have a smaller position in the one that you're giving more room. You're going to have a smaller position, or a larger position. You're going to have a smaller position in the one that you're giving more room to normalize the risk, and you're going to have a larger total position in the one that you're only giving 5%. And so, but it's pretty important that you make sure that 5% is, that means that the ATR of that should be 1 or 2 or 3, it should be some multiple. But the key is that once you've determined that, I mean, you pull up. I tell people that are learning. This is something, and I still do this sometimes. Everybody's got access to a portfolio tracker where you can go in and actually put the symbol, the number of shares, and all that in an actual tracker. It's easy to upload or just do it manually. Go and take 5 or 10 or 20 or 30 of your favorite stocks at any given moment, even like, tomorrow morning, and just go in there and just decide, put in a 5 or 10% exit and just let it rip and see what happens. I've done that randomly thousands and thousands of times. And I've done it at times, and I'll make a note of when I do it of what I think will happen, what my guess is, and you'll find that I'm pretty good at market direction, especially at major turning points. I'm not, in the middle, I just follow the trend but when it gets to extremes, I'm pretty good at having a really good feel for the peaks and the troughs. And that's where the edge is for some people, because that's what most people have a hard time with. And to me, that because I'm looking at a lot of different sentiment, I'll go on Twitter and see what kind of some of the people are doing the wrong thing at the wrong time. Most of the time, people are doing the wrong thing at the wrong time. When we get to extremes, that's a lot of very useful information. And you take that too. And so when people are really euphoric and, I'm going to be, I may pare back or lower my risk, but the essence of what I do, this is really the essence of asymmetry is the money management. And then once I get in a position and it's underway, then all this stuff gets adjusted. It's a continuous daily, I know, say if I had 10 positions at a time, which is what I typically running around 10, maybe up to 15, typically I'm probably running, and it may be ETFs and individual stocks. The individual stocks are usually going to be a smaller position size for obvious reasons. Why? Because the short-term volatility is going to tend to be a little bit there. Your volatility is how quickly and how wide prices spread out. And so, if I'm going to mess with a stock, I want it to be something that's going to move. So it's going to be a pretty volatile stock because I want it to move, because ETFs have a lot of advantages in that, they're all, most of the baskets of a sector, for example, are pretty similar to each other. And there's some mathematical details about how that works. And, you get into binomial distributions, probability distributions, for example. With a binomial distribution probability, you're thinking of, if I were to just execute this one signal that has a probability of, being right, 60, 70% of the time, that's one thing. But what if I'm able to do 10 or 20 of those at a time, or 100 of those at a time? Right. What happens is the overall portfolio has a higher probability because you've added, and that kind of comes down to true diversification. It's funny that the financial advisory world talks about diversification as in just buying a bunch of mutual funds, stocks, bonds, commodities, whatever they would consider that diversified. Notice what we do, and what I think any really good hedge fund manager does over a long period of time. Bridgewater, for example, Ray Dalio talks about having all these different bets and how the combination. Well, he's a math person knows what he's taught. What he really means is that's a binomial probability distribution, and where you're taking multiple bets and run them all at once, and then you get diversification too, because they're only risking small amounts in all these different bets. And so it gets very complicated. Most of your audience is probably doing more individual stocks and stuff, where really what you want to do is find something that you watch and you want to get in it, and just determine how much you're going to risk, which is a function of your exit price, and let it rip. I mean, I say that all the time. Just let it rip. And just assume you've already lost it. See, that's the key too, is because I've consulted with a lot of other money managers and a lot of people over the years. We actually, I can help other advisory firms, other fund managers develop systems. We can, I can act as chief investment officer for other firms and stuff like that if I want to, where, we're, doing all kinds of things. And so, I've been able to experience and firsthand for a very long time how other people think, and how, hopefully learn from their mistakes. I prefer to learn from other people's mistakes than to do it myself. And so I would always, I'm real big on trying to reverse engineer and break a strategy. Engineers, mechanical engineers or whatever, they're trying to break, you're really trying to break it. You're trying to figure out, what the crowd does. We see it all the time in social media, is that they're just following each other, and they're herding with each other, and they're looking for an echo chamber. I've completely done the opposite of that. I don't care about an echo chamber at all. I've always wanted to share my ideas and stuff with people who I know that probably wouldn't disagree. Maybe they're a big, money management firm that's more academic based and systematic and, whatever, quantitative, whatever. If they don't have that, my background of the thing that's unique for me in the professional world is that my background was charting and discretionary decision making under uncertainty before I developed systems. And that is pretty rare, because I know a lot of systems people and I know a lot of discretionary people, and I don't know anybody else that has really gone into depth that I have on both sides of that. And so I'm kind of in this weird, find myself, other people want to argue with me all the time because, they believe one or the other. And I'm just kind of, I believe in whatever works, and I'm going to do it. So, yeah. So I do believe there is a significant human element to it. And there's a whole lot of quants that fail. I mean, there's a whole lot of quants that don't do well over a long period of time. They go test a new model, and you can sit and watch them. I know of who they are, and they'll change their strategy every couple of years, because they back tested something, is all great, and it raised a lot of money, and then it didn't work out. You see that over and over again. And then there's discretionary guys or gals who it don't work out too, because there you get into a lot of ego issues and not want to take those losses and all those many things that can come into play. So, yeah. But yeah, I mean, this is the essence of it. And then once I get in a position, what I do after that is very, very critical as well, because once you're in it, if it doesn't go down and it goes up, which is the optimal thing that you want to have happen, then you gotta, you want to ride the trend to the end when it bends, so you want to try to capture that trend. And with stocks, as you probably know, these, if you're just looking at the IBD 50, for example, those are all, those are some of your top ranked stocks in the country. To me, I could just throw darts at them and just do this. And you literally, and you got to try that, because I've literally been doing that for a long time, where I literally just pick some stocks and put them in a basket and position size and all, do all those, and to see how it unfolds. So it's very important, I think, to do that.
Perfect. Mike, thank you so much for walking us through that. I think the position sizing is really going to resonate with people, especially with that percent ATR. To finish off the interview, I'd love to just kind of hear your general advice for new traders during this type of environment. Obviously, we've been in a corrective phase. We don't know how long this is going to last, but what general advice do you have for anybody struggling out there, or maybe new to trading in general?
Well, one thing is, in bear markets are made up of a lot of swings up and down. So the critical thing you need to do is go back, and at least with an index, if not individual stocks, go back and look at the historical bear markets. The 2007, October 2007 to March 2009 was a really, really good, great one. 2000 to 2003, I would go back and chart each of those. And what I would actually, because doing it, I used to chart point and figure charts by hand for a long time, and so you learn a lot that way. But what I would go back and actually identify what percentage ups and downs those are, so that you're aware of what these markets can look like. Because what's going to happen is if this is a prolonged, ongoing bear market, people are going to get caught in a loss trap. I mean, you're going to have what I call the piranha. You're going to get eaten up by the piranha as opposed to the shark. Some people will have the shark bite where they stay in and they just lose 50% in the bear market. Other people will trade in and out, and it'll be a whole lot of, and I call that the piranha. And neither one of them is a good way to go. So you really need to understand the swings of bear markets, and and at least you can't live it. I've lived them, and so I have I'm very stoic during these times, and I actually get excited during these times because this is when I do best, or at least when I stand out the most. So there's that. The other thing is to find a system that fits you and your personality, whatever it may be, and apply money management to it. What I talked about, the position size and the risk, that's the key, and just let it rip and just keep doing it over and over again. And if you can, and I, test it and quantify it, but that's I know that's easier said than done, but that's really the key, is to to determine what you want to be in, and determine how you're going to get out and when you're going to get out, and let it rip. And then after that, then determine, okay, as it moves on, have some sort of a trailing stop or trailing exit, so you capture the profit, or maybe scale out of it or whatever. So
yeah, perfect, Mike. Yeah, perfect. Mike, thank you again for your time. I'm sure a lot of people enjoy this one. If you did, please go ahead and leave a like down below and subscribe if you're new to the channel. And Mike, is there anywhere outside of Twitter that I should link down below for people to reach out to you if they have any questions or want to learn more about you or your system?
Yeah, if you Google Mike Shell Capital, you'll probably find me there. But our website's shell-capital.com. And I have asymmetry observations, where I've written quite a few observations over time. I've not been doing as much lately, but that's another resource. But and then of course Twitter's kind of a big one. I've been over there. I've been on there more lately than I ever have been. So
perfect. Well, Mike, thanks again once again for your time, and I really enjoyed this one. And thanks everybody for watching, and we'll see you guys in future videos. Thanks.